Well, good morning, managerial accounting students. I always find these videos are more interesting if I bring along a guest with me. So I brought with me today Don Quixote. If you don't know who Don Quixote is, you may want to Google it. And there's a song from, it's a character, Man of La Mancha he was called, and there's a song called The Impossible Dream. Out of my respect, my wife being in the next room, I will not sing it to you for you. But thank you, Don Quixote. He may not say much, but he'll be here. The purpose of this little mini lecture today is to finish up Chapter 8. There were two things that we did not lecture on in class. I want to lecture on now because one of them is in the homework, and these are fair game for the exam number 2, which you have next week as well. So they have to do with financial budgets. So, we've talked about all different types of budgets, but we haven't talked about financial budgets. And when you think of financial budgets, think of budgeting for cash, making sure that we have enough cash to pay our bills, getting a sense of what cash is coming in and what cash is going out on a monthly basis, weekly basis. Some businesses even do it on a daily basis. And also we have capital expenditures. A company needs to invest in property, plant, and equipment as well. So we'll look at capital expenditures. And then we'll also, as we always, is our custom in this course, after we get done doing all these budgeting topics for manufacturers, we will revisit for non-manufacturers or service organizations. So those of you who like to follow along in the slides, I'm going to pick up here with slide 50. And let's see if we can get that nice and big on the screen. Nice and big, not only nice, but big as well. Okay, so for financial budgets, so again, we're going to include both cash budgets and we're going to include the capital expenditures budget. We're going to estimate our inflows and outflows for a period of time. These budgets are normally integrated with the other budgets that we've talked about. And we also have to put together a budget for capital expenditures, which I mentioned. Also, some large companies pay dividends, and they may need to, particularly if they have to fund the acquisition of property, plant, and equipment, they may also have to issue a long-term debt and so forth. All right. So these cash budgets I mentioned before could be prepared annually, they could be prepared monthly, they could be prepared weekly, or sometimes in some businesses they even do it daily. Our norm in this class is we'll be looking at cash budgets on a monthly basis. So here is the example that will work, and I think this one's pretty similar to the homework assignment that I've given you here. So we've got we want to do a monthly budget for January and February and March for this company. First of all, we want to estimate our receipts. So let's assume for the time being that the only receipts that we have are from our, get this thing out of the way here. The only receipts that we have are from our sales, the collection on sales. So notice here we've got sales for January, February, and March. And this is our accounts receivable balance as of the beginning of January. So what we want to do is we want to put together the cash receipts from sales. Let's assume sales are their only source now. Assume that that 40% of the sales are from the current month's account, and 60% is 40% rather is from the prior month, and 60% is from the current month. So when you look at March, for instance, we're going to assume that in March, we're going to collect 60% of the $970,000, and we're going to collect 40% from the $1,240,000 from the before. All right, so here is our sales for January, February, and March. Here's the pattern. We assume that we're going to collect 40% from the prior month's sales and 60% from the current month's sales. And we're also going to assume that for the month of January, that's the accounts receivable balance as of January 1st, let's assume all of that's going to be collected. So with that information, we can ask ourselves, how much cash are we going to collect from sales for the months of January, February, and March? So here goes. Let's just take a look at February. So February, we had $1,080,000 worth of sales. So 40% of those sales are actually going to be collected in the month of February. So that's where you get 40% of 1,080,000, gives you to 432. And the budgeted sales for February are 1,240,000. And we know that our pattern is we're expected to receive in the current month 60% of the sales for that. So if we can do that for the month of February, then we can do it for all 3 months. So here is the cash to be collected from sales, January, February, March. Note A is the amount that we collected from the prior month's sales. And column B is the amount we get from the current month's sales. So we had, if we just start with the from the prior month's sales in January, they told us that we had $480,000 worth of accounts receivable for January. So that's where I got my $480,000. And then what happened is you will collect in for February, you've got 432,000 times 40%. That's from the previous sales months. Okay, that's your $1,080,000. Okay, and then you've got you've also got there so you've got for February, and now for March, you've got 40% of the previous month's sales, and those would be the sales in February. Right? So those are from the previous month's sales. And now you also have the sales, the cash that you collect from the current month's sales. So here's where the sales for January, here was the sale for February, here was the sales for March, you collect 60%. Right? So it's pretty simple here to forecast. Again, this one's very similar to the homework, to the collections from sales. So it's 40% of the previous months and 60% of the current month. Right? So that's how to forecast collections on account. Now, we also have to forecast cash going out, cash payments. Now, you may recall, you may have touched upon this in Financial Accounting 1, and I think 1 or 2 of you may have had Financial Accounting 2. There are some expenses which are non-cash expenses. And you saw the difference between this, when you do the income statement, one of the items that you're going to show on the income statement is going to be depreciation. But depreciation, you may recall from Accounting 1, depreciation, when you recorded depreciation, you debited depreciation expense, you credited accumulated depreciation. So depreciation does not involve the use of cash. So if you look at the budgeted manufacturing costs for January, they're $840,000. But for the month of January, that includes $24,000 worth of depreciation. And actually, the charge for depreciation per month is $24,000. So though these are the amount of the expenses that we're going to have for manufacturing and manufacturing costs for January, February, March, the cash going out is not going to include the depreciation expense. So it's actually 840 minus 24, 780 minus 24, 812 minus 24. Here is our accounts payable balance as of January 1st. And the way that we pay for our manufacturing cost, it's 25% from the current month and 75%, I got it wrong again, 25% from the prior month and 75% from the current month. Say that again, 25% from the prior month and 75% from the current month. So similarly, what we did with the collection on accounts receivable, we can now also do with the payments that we need to make for our manufacturing costs. So if we focus in on the month of February, for instance, so for the month of February, here are our total manufacturing cost. I subtract out the depreciation. So there is the manufacturing cost less depreciation. And 75% of the expenditures for manufacturing costs are going to come, so 75% of the manufacturing cost less depreciation for February, and it's going to be 25% of the January 840 minus the 24 gives you the 816. So these are the total payments that we're going to make in February. Right? So again, we've got 25% from the previous month and 75% this month. So if we can do that for February, we now can do that for all 3 months there. So similar to what we saw in the collection on accounts receivable, you can assume that all of the accounts payable that we had at the beginning of January was going to be paid in January. So that's how we got January's there for note A. And then note B, for the current month of February, we had $840,000. And then we subtract out, again, from the previous month, rather, we had $840,000 minus the 24, that gives you the 816. Right? And then And then for the month of March, we had 780,000 minus 24. And you can see that's where the 780,000 minus 24 was right there. Okay. So that is the amount that we have to pay from the previous month. And then 75% of the cost actually incurred this month. So you go back to the actual costs incurred for this month. There they are. So each month there. So you got to take this amount and you got to subtract out the 24,000 for all three of those months. So 840 minus 24, 780 minus 24, 812 minus 24. And you multiply that by 75%. And this is the amount that we're going to be paying in this month, 75% of the current month's manufacturing costs. So now we can forecast we're going to pay this amount in January, this amount in February, this amount in March. Right? So now that we've done that, and we've done now estimated cash receipts, we've done estimated cash payments, we can figure out what the increase or decrease is going to be. We can take a look at the cash at the beginning of the month. And then we take a look at the cash balance at the end of the month, less the minimum cash balance. So here's where we actually forecast whether or not we're going to have a deficiency. And if we have to have a deficiency, this is where businesses may set up a line of credit with their local bank, where if they know they're going to be running short, they can draw against that line of credit, or maybe we have to take out a short-term loan. Okay? So this is how a business would actually forecast its cash. So it's the estimated cash receipts less the estimated cash payments. That gives us the increase or decrease in cash. What was the beginning cash? That'll give us the cash at the end of the month. And if the minimum cash balance that we want to maintain is less than that cash balance out of the month, then we're going to have to arrange some type of credit to make up for the difference, because we don't want to fall below our minimum amount of cash balance. All right, so here's an actual illustration. So this was the balance that the company had in January. Here's the quarterly taxes paid. Here's the quarterly interest paid, quarterly interest revenue received, and sewing equipment purchased, and selling and administrative expenses paid each month. So our budget is going to include other than the collection on account. So we've got actually, in this case, we've got some. We may have some additional money coming in. So here we got interest revenue of $24,500, which was a receipt that was not included in the schedule we did earlier. And we've got some payments going out that are for that we hadn't budgeted for previously. And they've given us, so this, we've got this payment in March 31st. We got interest coming in on January 10th. We've got interest revenue in March of $24,500. We've got a capital expenditure of $274,000 that we have to pay in February. And then these are the selling and administrative expenses each month. So we put all these together, and now we can do the cash budget for the month. So here you'll recognize some of these things. This was the schedule of collections from sales that we had done previously. And notice here for the month of March, we've got to add in the interest revenue. And then we've got our manufacturing costs, which we had done earlier. And then we've given us this additional information of the selling and administrative expenses, the capital acquisition we made, the interest expenses we have to pay, and we also have a tax payment we got to pay at the end of March. And then you can see here that it looks like we're okay for the month of January. We're going to be $5,500 short in February, so that may require us to do some borrowing or drawing against the line of credit. And I say we're short, we're falling below the minimum balance. We want to keep a minimum balance at all times of $340,000. So if we know we're going to fall below that minimum balance, then we may want to take out a line of credit. Right? So here's how you pull them all together. So theirs was your collections on account. Theirs was your estimated payments for the manufacturing costs. And then I factor in my other sources of revenue, such as interest, and other sorts of cash coming in, such as interest, and the other expenditures that we didn't include in our manufacturing costs. So that's how to do a cash budget. All right, we also have a capital expenditures budget. So this is a budget that we use for acquiring fixed asset. We had a little bit of this in that last exhibit that we did here. Notice we had a capital expenditure here of $274,000. Now, although it was incurred in that month, a capital expenditure of that magnitude is not something we do on a monthly basis. Those are things that we basically do capital expenditures maybe once or twice a year, and we plan for those well in advance. So here, notice when we do the capital budget, we do a capital budget for a series of years here. So here's in fiscal year 1. So companies looking well out in advance in terms of additional equipment purchase they have to make. So when they put together their cash budget, in addition for budgeting for their manufacturing cost and the payment of taxes and selling and administrative expenses on a cash flow basis, they also have to account for these capital expenditures as well. Now we can tie this all together, and we do a budgeted balance sheet. And all a budgeted balance sheet is a form of, teach a little bit of Latin here, pro forma, which simply means advance. So a pro forma or budgeted balance sheet is simply a balance sheet based on our budget for some period in the future. So your budgeted balance sheet is going to look just like your historical balance sheet. The only difference is our forecast of what the balances will be in the future, as opposed to what they were at a particular date in the past. All right, little check here. Which budget summarizes the plans for acquiring fixed assets? So let me ask Don Quixote here. Don, what do you think here? Well, Don tells me in El Español, tengo 3 años de español en mi escuela de secundaria, he thinks it's the capital expenditures budget, which is the budget we do for the purchase of property, plant, equipment. And I would happy to know, Don, you got muy bien, senora. You got that correct. All right. So what we do, this last topic here, what we do is what we do for manufacturers, we can also do for non-manufacturers. So what's going to be different here is we're not going to have a manufacturing, we're not going to have a budgeting manufacturing cost. We're not going to have direct materials. We're not going to have direct labor. We're not going to have factory overhead. Primarily, our biggest cost is going to be labor. So a good example of that would be for a hotel. So we've got a hotel that has 150 rooms that average 120 guests per night during the weekdays and 50 guests per night during the weekend. So it looks like we're busier during the week. Maybe this is a business person, notice I didn't say businessman, a business person hotel where they anticipate having more guests during the week than they do on the weekends. So if you want to budget, let's say we're trying to budget for the cleaning staff. So there are the number of guests per day on a weekday basis and a number of guests per day on a weekend basis. All right. So you figure a housekeeper can clean 10 rooms in a particular day. So notice we're going to need 12 housekeepers a day for the weekday, and we're going to need 5 during the weekend. So we take a look at for weekday, let's just focus on weekday here. So we've got number of housekeepers per day is 12. They've got 8 hours per shift. And we're assuming that we've got 260 days. How did I get that? So I took 52 weeks and I multiplied by 5. That gave me the 260. So that's the number of hours per year multiplied by the rate per hour of $15. So our weekday budgeted housekeeping cost is $274,400. On a weekend, number of housekeepers per day, we've got 5, and we've got 8 hours there. And in terms of the number of actual days per year, so 52 weeks times 2 gives me the 104. Yeah, 4160. I multiply by $15 per hour. So now this is how I would put together the labor budget for the housekeeping costs. Okay, so let's end there. I think that's enough. I'm not worried about that multi-period budgeting here. That's enough for you to master here. So if you haven't done so already, what I would suggest you do is go ahead and do that. Go do the homework. And one of the homework actually has to do with a little bit of the cash budgeting, which I just illustrated. So from me and my colleague, Don Quixote, we wish you well, and we will see you again soon. Actually, very soon, on Tuesday. Be well, everybody. Bye-bye. Enjoy your day.